It's a very special conversation we're having today with Professor Stephen Penman, an authority on security analysis and value investing. Stephen Penman is the George O. May Professor Emeritus of Financial Accounting in the Graduate School of Business at Columbia University. He's been teaching finance, security analysis, and accounting for almost 5 decades. He started at the University of California at Berkeley, where about 26 years ago, he taught a course titled Financial Statement Analysis and Security Valuation, which was extremely popular at the time. And one of the students that took the class in 1998 was me. And I can say that no other course has shaped my professional thinking in such a profound way as the course I had with Professor Penman at the time. We'll speak today about core ideas in his new book and also approaches to valuation and specifically the valuation of damages. Professor Penman, thank you very much for speaking with us today.
It's a pleasure. Thank you for inviting me to join you.
You published a book earlier this year, co-written with Peter Pope, called Financial Statement Analysis for Value Investing. Could you give some historical context around value investing and fundamental analysis, perhaps Graham and Dodd, the importance of accounting, and especially good quality accounting?
Yes, well, as I read it, and I try to read back in the history because it's very important for us to keep track of the history. Of course, people were buying equities or buying firms for thousands of years, presumably. But I think formally value investing got going back in the late 20s and early 30s. During the 1920s, as we know, was a boom time. And accounting was very much involved in those days of writing up assets to actually what you might say speculative values. Similar, I guess, today in terms of the call for writing up very, very speculative intangible assets on the balance sheet. Well, we know what happened in October 1929. These assets on the balance sheet evaporated, okay? And that became, drew a call from Benjamin Graham, but also John Maynard Keynes. No more water in the balance sheet, please, okay? Whereas Keynes actually had lost a lot of money, as I understand it, during the 1920s, he then turned, as Benjamin Graham did, to fundamental analysis. Let's have good accounting and let's look at the fundamentals, understand the businesses, and invest on the basis of that understanding. And that is the beginning, I think, of value investors in any formal sense. And it goes on from there. What happened, of course, in the US was in 1933, after the crash, we had the Securities and Exchange Commission came into being with a very strong mandate. No water on the balance sheet. We want good conservative accounting that you can actually trust and rely on. So that's the origin of value investing. Benjamin Graham was the prominent leader of it, of course, in the United States, professor at Columbia. Warren Buffett was one of his students, and that's been perpetuated through the years. We'll just again note the tie of fundamental analysis to accounting, okay? And that the two work together out of that experience in the 1920s, the early 1930s.
What was the motivation for the book? Who is the target audience?
The target audience is value investors or potential value investors, students of value investing, and that is a wide range of institutions, practical individual value investors, but the book also functions as a textbook for students, young people wanting to get into value investing. So it's a textbook with a lot of additional materials for teaching, cases, exercises, and so on and so forth. But I think the prime audience is practical value investors. As you know, I have earlier books, one called Financial Statement Analysis and Valuation, Security Valuation, the same title as that course that you took, Heiko, in Berkeley, which was written as sort of traditional textbook mode. We decided to write this book in a much more active style, okay, to active investors and in a much more conversational style. I'm finding that students these days are not buying textbooks. One reason is the price. My earlier textbook, Financial Statement Analysis and Security Valuations, cost $250 in the United States. Shocking. Okay, the publishers charge it. They're not buying the textbook. They get the notes from the professors. But the idea here is if there's a book that comes along that investors, practical investors, are using and looking to, then students may be encouraged to pick up the book and really try to internalize it. So that's sort of the two audiences, and that's the strategy behind the book.
I'd like to focus on the residual income method, which is kind of the core valuation idea in the book. Could you walk us through the origins of the residual income method from Edwards and Bells to Olson and yourself, your own contributions?
Well, I think I've done a bit of historical research here and gone back further. The residual income model actually has a long history. It actually has a longer history than discounted cash flow analysis or dividend discounting. Schmallenbach, a German academic, wrote very extensively using the residual income model back in the 1920s. In Sweden, with Johansson, they were using the residual income model. In the US, the first writings I've found are by Preinreich, who was a professor at Columbia, actually. In a couple of papers, he refers to the residual income model. Actually, going way back, it turned out if you go back to the UK, where you guys are, they were doing valuations based on what they called excess profits, okay? Way back in the early 1900s. And excess profits, of course, is a residual income notion. But actually, I found one delightful thing. I think one of the books refers back to a student essay in 1888 in London, where a student lays out the residual income model. Fascinating. Now, it turns out that as things progressed in academia, John Burr Williams came in 1932 with his very famous book saying it's dividends. They're the payoffs. That's what you've got to forecast. And so that was adopted by academia. And then subsequently, as we realized that the dividend discount model doesn't quite work, it's not very practical, then discounted cash flow came along as the predominant valuation technique that we taught in business school and in many business schools still, and in practice. As you mentioned, residual income model was revived by Ken Peasnell at Lancaster, University of Lancaster in 1982, by Edwards and Bell in 1961, and Jim Olson by 1995. And this was my education to get back into this model, because the other models were in my mind, are very unsatisfactory. So that's a brief history.
Yeah, that's fascinating. In my mind, the residual income method is connected to fundamental analysis, but that wouldn't necessarily have to be the case, right? How do you place the development of the residual income method in the context of fundamental analysis?
Well, I think actually there's a sort of an imperative here in my mind, and because it brings in the primary financial statements the firm has, which are balance sheets and income statement. A discounted cash flow analysis has cash flows, of course, okay, free cash flows. So I'm of the persuasion, and it's a pretty strong conviction, which comes out in the book, that actually to get hold of the fundamentals, you've got to use both the balance sheets and income statements. They complement each other through double entry. Focusing just on earnings, single entry, doesn't do it. You've got to use the balance sheet at the same time. And focusing on cash flows, I think actually gives you a lot of practical problems when you're actually doing valuation. So it seems to me a very natural logic. Yes, indeed. These are the primary statements that are published: balance sheets and income statements. Analysts forecast earnings; they don't forecast cash flows. Um, I think this is the appropriate arena, and I think our teaching DCF analysis for so many years has, and that becoming so ingrained in practice for so many years has been a disservice.
Most valuation experts, most courts, most arbitral tribunals today would consider the DCF method to be the most sophisticated valuation approach. So I'd like to briefly contrast the DCF with the residual income method. And I think it's uncontroversial, it seems to me, that if one uses consistent assumptions, then the two methods will deliver the same result, at least in theory. So in a sense, the DCF is also an earnings-based valuation method, I guess, only one that's based on cash earnings with no accruals in the balance sheet. There's only one item in the balance sheet at T0, that's cash. Is that the right way to start thinking about a comparison?
Yes, the comparison starts with exactly what you say. There is no difference in the valuations if, and the if is if you forecast for the very long term. Okay? As we write down these models, we actually write them down as here's the expected payoff to infinity. Okay? Now, to infinity is a very long time. Okay? But they do give you the same valuation. If you forecast 10 years, 20 years, 30 years, you'll get the same valuation. But that is a huge practical problem. In the long run, we're all dead. Okay? Forecasting the long run gives me at least serious psychological problems. Okay? I can think about what we have now, what's going to come through in the next year, the next few years, perhaps. But then it's all very diffuse. Discounted cash flow, it works in the long term, but it rides so much on that long term. If you do a DCF valuation, you know what you have to do. Forecast free cash flow next year, the following year, and so on. Maybe for 3 years, maybe for 4 years, and then you've got this wretched terminal value, okay? And then they tell you, as we teach it, you plug in a growth rate. Okay? Now that is very speculative. Now, if you really look at these DC valuation, even for a mature firm, the amount of value that comes from your forecast of free cash flows 1 year ahead, 2 years ahead, 3 years ahead is a very small part of the valuation. It rides on this huge terminal value, which is the long term, which is what we don't know much about. Okay. An example, and I call it cash accounting for value, okay, versus accrual accounting. First of all, ignores the information in the income statements and the balance sheet. But here's an example. Firm has a defined benefit pension plan. The pensions are going to be paid out 30 years hence to employees. Discounted cash flow analysis requires you to forecast those cash flows 30 years hence. All the best of luck. Accrual accounting says, oh no, we'll accrue that liability on the balance sheet and we'll reckon the current service cost as an expense in the income statement. We'll bring that future forward, okay? So you don't have to forecast that. The other thing with free cash flow is you forecast free cash flow is the cash coming in from operations. Well, we like that stuff, okay? Minus cash investment. Cash investment minus. Usually we teach that investment generates value. Yeah, I know about that corporate jet that maybe is a bit of a loss thing, but it treats investment as a negative. So if you have firms that generate free cash flow, Walmart generated negative free cash flow for 30 years. General Electric, for many, many years, generated negative free cash flow. Why? Because the investment is treated as a negative. That is perverse accounting. You get more free cash flow by liquidating your investments. And so it's as the theme of the book is, valuation is a matter of accounting. How do I do my accounting? Well, cash accounting, as we're taught in beginning accounting class, doesn't really capture it. In fact, it can lead you into real problems. The most serious problems is most of the valuation rides on the speculative terminal value in the calculation. And that growth rate, that's very troubling. So the book says, no, let's use the information on the balance sheet. We actually have those investments. That free cash flow says a negative. We actually have some as a positive on the balance sheet. We actually have those pension liabilities on the balance sheet. Hey, as long as the accountant's doing a good job, of course, let's use that. And that brings the future forward. So this problem of dealing with the long run is reduced. It brings the future forward in time. That's the nature of accrual accounting.
Let me challenge that a little bit. How do you respond to someone who asserts that the RIM does not really introduce additional information? So accruals in the RIM unwind over the projection period, and the residual income method therefore just catches them earlier in the T0 balance sheet instead of in the projected cash flows, they might say. How do you respond to that?
Well, those statements are correct, except, as you said before, correct in theory. If, in fact, you can get to a point where all these things unwind, okay, into cash flows, yes, the investment's on the balance sheet. Eventually, they're going to produce cash flows. If you can get to capture those cash flows, then yes, you've got it. It's just, as you said, it's a matter of timing. But thinking here and thinking about what those cash flows are going to be without the investments on the balance sheet, what the payments are going to have to be 30 years hence on the pensions without the accrual accounting, it brings it forward in time. And so that gives you a secure valuation. There's still a lot, in many cases, riding on the terminal value and the residual income model. But that's really saying, here's the part that I'm uncertain about. The higher your terminal value or your continuing value is the higher is your uncertainty. And a residual income model, if you've got an R&D startup, you've got a very high internal residual value. But the properties of accrual accounting is it just changes. It's a basic proposition. Over the lifetime of a firm, the total earnings and the total cash flows are the same. It just alters the timing of the capture of these things. And accrual accounting has the feature of bringing it forward, the cash flows forward. So what you've got present now, earnings now predict future cash flows. So in fact, if I've got earnings and there's a pension service cost on there, it predicts those future cash flows, as does the liability on the balance sheet. So that is the accounting advantage in using the accrual account.
Yes. I'd like to link the accounting-based valuation models like the RIM to current market valuations. So we are seeing exceptionally high valuations currently, especially of tech companies. I looked up the average price-book ratio of the S&P 500 yesterday. It was 5.4. That's unusually high. Yeah. I think the last time it was over 5 was during the dot-com boom. And NVIDIA's PB ratio, for example, was over 40, which means that about 97% of value is not on the balance sheet. So only 3% of the value that the market sees is recorded in the balance sheet. And against this background, what do you respond if someone claims that accounting is losing relevance, especially in tech-driven markets, with tech-driven market valuations?
Well, I think that's the case. Price-to-book ratios have increased. Just keep in mind, you said this represents the value is not captured by the account. It could actually also be overpriced companies, okay? So in fact, the price-to-book ratios are high, and they were high in the 1990s because, in my view, we were in a bubble. Excessive prices, particularly in the tech and telecom sectors, okay? So that says an average price-to-book ratio of 5 or 40 for NVIDIA is something to be challenged through your fundamental analysis. But even so, if in fact they were, let's say, efficiently priced, those price-to-book ratios would be high. And the reason is the increase over the years The old standard was about 2.2 with the price to book ratios. Is that so many assets are not on the balance sheet, particularly in the tech sector? Remember, your S&P 500 that you're referring to is dominated by, a handful,
Yes.
10 tech firms. So that raises the question of, I think you might want to ask me later, about these tangible assets in the balance sheet. The initial answer, the quick answer is, those who say accounting is missing out on value because assets are not on the balance sheet don't understand accounting. There is also an income statement. So, Coca-Cola, its price to book ratio is above 5, okay? It's 6 or 7, last time I looked. Why is it off the balance sheet? Why is it 6 or 7? It's because a big part of their assets, the brand, is not on the balance sheet. In the US, at least, you're not allowed to put brands on the balance sheet. As under IFRS, in the UK in the old day, there was some allowance for that, okay? But it doesn't matter because the earnings from the brand are coming through the income statement. And so you can refer to the income statement. And it is a basic property of valuation property of accounting, is that if the earnings from an asset are coming through the income statement, you can value it based on the earnings, and it doesn't matter if the assets are not on the balance sheet. In fact, in the book, I think we've got Coca-Cola, where we say, okay, here we've got a price to book ratio of 6, 7. That brand's missing from the balance sheet. We've got to put the brand on the balance sheet. And so we go through the exercise, putting the brand on the balance sheet. That, of course, reduces the price to book ratio, but it doesn't change the valuation because now the residual income or the return on the balance sheet, the return on equity, is actually a lot lower. So shifting from the forward residual income or the return on the book value to have a higher book value doesn't change the valuation. That's a property of accounting. A property of accounting is you can get value from the balance sheet, you can get value from the income valuation from the income statement, but they both work together. You can't interpret the earnings, the profitability of Coca-Cola, which is high, because the earnings are high relative to book value because the book value is low. You've got to bring the book value with you. And so that's the way it's got to go. So that critique that accounting is remiss if in fact doesn't get the balance sheet right is not quite correct. Now you have the situations, of course, where in fact you're investing in intangible assets and the earnings are not yet coming through the balance sheet, okay? But that means you've got to pro forma what those earnings are going to be. For a startup, an R&D startup, where there's nothing much on the balance sheet except cash burn, it all comes up to actually modeling if in fact they'll get the profits in the future, okay? And that's a very difficult problem because the R&D, 85% of R&D is not successful. That just tells you you've got a very risky company here. Be careful.
If you were free to design a more perfect set of accounting rules that, say, US corporates would have to follow, say the Penman gap. So as a result of adopting the Penman gap, would the average price-book ratio of the S&P 500 likely be lower, for example, because more intangibles would be on balance sheets? Or would it be higher because, for example, more debt-like items would be, like leases or factoring would be on the balance sheet, or would it be about the same?
Let me just say, first of all, I think the basic US GAAP accounting and IFRS accounting is pretty good accounting, okay? There are things around the edges that I would change. Leases you mentioned, now finally they've come to put operating leases on the balance sheet, okay? So that one has been satisfied. And that, of course, has changed the price to book ratios. But here's the way I think about it. When you do fundamental analysis, you first look at the balance sheet. I'm buying a balance sheet. And you'll notice in the residual income model, the balance sheet is not discounted. it goes one to one into price or to value. So you want a balance sheet which is a low risk balance sheet. That is a balance sheet which is not going to come back and hit you later. Benjamin Graham and those initial fundamentalists said, no more water on the balance sheet. You put water on the balance sheet, it evaporates. It'll come back and hit me later. That brings a critique to fair value accounting, how much fair value accounting you want into in your balance sheet, because that writes up assets sometimes to speculative amounts, as in the 1920s. But also you want to recognize the liabilities, okay? I don't want anything there, anything on balance sheet or off balance sheet which is going to come back and hit me later, okay? So that's my basic idea. That's a conservative balance sheet. That is the balance sheet that was really put in place when the SEC was created in 1933 and 1934. So what would I do? Well, there are some things missing in the balance sheet. Take on liabilities. Think about contingent equity. Think about convertible bonds. The way we account for them, at least in the US, you do have an option, I think, to do it differently, but most firms don't do it in Europe. You just book it, the bond at the face value. Let's say you issue a bond with no interest rate, okay, but very generous conversion principles. You hold the bond, no interest is reported, and when the bond is converted into equity, there is no accounting. It looks like the firm has zero financing. Now, we know from our basic finance, it's very good, very difficult to get a loan where there's no interest cost, okay? So the accounting is remiss. Why is it remiss? Because there's not a liability book there to actually give up value in terms of your own dilution, shareholders' dilution, issuing paper to satisfy the conversion. That's an omitted liability, and it can be applied for all convertible securities, including stock options. Okay, so that's not on the balance sheet. So that's one thing I would be concerned about. I would worry about a number of years ago about the fair value accounting, which was gaining momentum, particularly on the IASB. I think that's not so prevalent now. The global financial crisis, when all those fair value water in the balance sheet collapsed, okay? For all those mortgage-backed securities and other assets marked to market to fair value on the balance sheet in banks, it was, again, a 1929 lesson for us. So that's not that much of a concern.
I'd like to move on to the assessment of damages or the valuation of damages, and to put some context around it for our listeners. The damages cases we're concerned with here for this discussion relate primarily to accounting errors, where, whether intentional or unintentional, the target's accounts in M&A transactions, for example, were misstated, and the seller had warranted the misstated accounts, and a W&I insurer may have insured them. So a damages award is supposed to restore the wronged party to the position they would have had the wrongful act, in our case, the accounting misrepresentation, not occurred. So to this end, the assessment of damages compares the value based on the incorrect financial statements with the value based on the corrected financial statements. It often equates the former with the price paid. That's called a rebuttable assumption. And it was on the basis, as it was on the basis of the incorrect financials, that the parties agreed the price. And the difference between the two is therefore a commercial measure of damages. In many cases, the same financial statements that were warranted and later turn out to contain misstatements form the basis of the damages in both as warranted and as corrected scenarios. If the warranty relates to the very same financials that anchor the damages valuation, but for some reason, the residual income method is not gaining traction in damages valuation. And I was just curious to get your thoughts on this.
Well, I think I agree completely with your thought about it. about the financial statements that the acquirer is primarily buying in an acquisition on the balance sheets and the income statements. That's where the accrual accounting is, where the misstatements can occur, okay? Yes, there can be some manipulation in cash flows, but it's relatively minor, okay? It's in actually setting the accruals and the estimations in the accruals where I think a lot of these misstatements happen. So it seems natural to me that, yes, when you're doing an acquisition, and this is on the edge of my expertise here, it's more in your ballpark, Heiko. Um, uh, uh, when you do an acquisition, you got to think about what those financial statements look like and what the consolidated financial statements are going to look like, given the synergies and so on. So, looking at that pro forma with the bad accounting versus the pro forma with the corrected accounting would seem to be a basis to actually give an indication of what's lost. Okay. And the assessment of the damages.
I'd like to explore one particular observation in the book that struck me, which is that there is no such thing as intrinsic value. That's important in our context of damages valuation, as damages assessment is precisely that. It tries to restore intrinsic value. And as you write, this goes back almost 100 years to Benjamin Graham, and you give the analogy of predicting the weather. If I summarize the argument in the book, it is impossible to predict the weather a year, let alone 10 years out. The weather in the distant future is indeterminate, and so it's not a useful activity to predict it. But courts and tribunals, on the other hand, need to award monetary amounts, and damages often do discount future returns, often into the distant, indeterminate future, such as in the case of a going concern where the financials were misstated. And ultimately, courts or tribunals need to award a single monetary amount that puts the wrong party in the same position, but for the financial statement misrepresentation. So I'd like to ask very specifically, as a conceptual matter, is the argument here that there is no intrinsic value per se, that it doesn't exist, or is it that an intrinsic value does exist, only that it is unknowable, at least with our tools today, and so one might as well not even attempt to assess it? Or coming back to the weather analogy, there will be a weather 1 or 10 years from now. It's just we don't have the tools to predict what it will be, at least not at present, although we've been improving our ability to predict the weather by about a day for each decade over the last 40 years, I learned. So the argument in the analogy is not that the weather is indeterminate, in the indeterminate future doesn't exist, only that we can't really predict it. And conversely, therefore, for valuation, is there an intrinsic value, but we simply cannot assess it? Or is the idea really that an intrinsic value does not exist in the first place?
Well, maybe I'm going to give quite a long answer here. The book is written primarily for equity investing, okay? So it's written largely in the mindset where there is a price that the market is asking you to pay and whether you want to pay that price. So there's no chapter on how you might assess damages in a legal dispute, in a divorce, or an estate settlement. So I'm actually a little bit out of my comfort zone here, Heiko. But to your answer, what the book says, for investing, it's not good. It's best to think that there's no such thing as intrinsic value, okay? Which seems like the problem, because we always say price is what you pay, value is what you get. You've got to find the value. But the book says it's best not to think about the job. Your job is to go out and find the intrinsic value, because of all the reasons you mentioned. And Benjamin Graham actually said, yes, it's very elusive trying to find it. It's not as if you can go into the woods and find an intrinsic value. Okay. So the book takes the following approach. Now remember, this is for actually buying a firm where there's a price, okay, which could be an acquisition, okay, a proposed price, a traded price. It could be an offer to sell from a private firm that's not traded. The best way to think about it is, don't think that your job is to go out and find the intrinsic value. All your job is to do is to understand whether the traded price is one you want to buy at. Now, mentioning Benjamin Graham again, he had this analogy of investment being a negotiation with Mr. Market. You talk to Mr. Market about the price. And so the book is set up under that idea. Well, Mr. Market, here's your price. What I want to do is understand your thinking in the price. So using the residual income model with good accounting, you get a reverse engineering mode. What is in fact the thinking in the market price? What's Mr. Market thinking? Okay? And that indeed is when your fundamental analysis starts. Well, he's thinking that. He actually sees this much growth, and we can actually convert this to a growth rate, that elusive growth rate. Rather than saying, I'm going to put a growth rate in and speculate on the future terminal value, we ask, well, here's Mr. Market's growth rate. Can I justify it? Well, that implies, well, for NVIDIA, that implies a certain sales growth in the future at certain margins. Do I think that NVIDIA can actually do that? And if the answer is at a price-to-book ratio of 40, no, then not today, Mrs. Murphy, I don't want to buy. So that is sort of the approach. Okay, now you pull me into the situation where there's litigation over damages, in which case the idea that there's no intrinsic value, no intrinsic value is a little bit off, except to remind you, as with the weather forecasting, it is very elusive. Okay, the answer to that would be that to actually justify a given damage claim or defense against a damage claim, to actually continue what's in the book in terms of pro-forming out the sales, the growth in the sales and the margins and so on, that would justify the damage. So you get back into the same thing. It's a matter of actually pro-forming that. Now, in the end, I don't know how your face judges, I don't know how they think about it. They probably think what you're bound by is sort of the common wisdoms of judges who say, well, the main valuation method is DCF, so that's what we're going to use, okay?
Yes.
Getting an education across to think about it differently, when you're in court next week, it's rather difficult. But I think we do have an education problem to think about it. And a good way to start is, hey, don't pretend you can actually pin down the intrinsic value. The game is not a game against nature, going into the woods and finding that intrinsic value in the forest. It's a game against other investors. So if you're claiming, you are claiming, the other side is claiming these damages, hey, give me a pro forma that justifies this is what I've lost. Because a damage claim is actually a price, right?
It's actually price. Usually there's no market price in these.
There's no market price, but let's say someone's trying to sell you a private firm. They said, this is what I want for my firm. You do have a price.
Yeah.
Okay. In the damage claim, there is an implicit price which you can actually challenge. And I think that's probably the way to do it. But man, I got to tell you, I've not been there. Okay.
Yeah.
So
with the disputes, it's often that there's a value that's promised, and then a value that was actually delivered that's lower. And the promised value is associated with a set of financial statements that turn out to be false, and so they're corrected. And so one compares two values. There is no market price in that sense. These are private companies. And so one needs two present values of future cash returns or residual earnings returns and compare them, and the difference is then damages. But to do that, one needs a discount rate. It's not sufficient in these cases to re-engineer a margin of safety against a hurdle rate, but you need a discount rate to start with, and so you need a cost of capital, which gets me to my next question, which is quite related, which is the principal battleground in many of these damages assessments. That's the cost of capital. And you address it in your book. You write that after 70 years of research, we really don't know what the cost of capital is. You note that the CAPM does not work, but I'd observe that the CAPM is essentially used in an overwhelming majority of DCF valuations today, at least those that I get to see. And it can seem surprising that the CAPM, which was developed in the early 1960s, is so dominant in damages valuation today, while there are other multi-factor models. Some of them have hundreds of factors. They play hardly any role for most practitioners. They play effectively no role in damages valuation. And what I find surprising is that it took the world's practitioners and standard setters something like 60 years for an almost universal adoption of the CAPM, until it was absorbed even by very slow-moving standard setters, say in Germany, where I'm from. But a few years after its original introduction, the empirical and conceptual problems already were quite clear. So I'd like to ask you, what is your take on this? Why does there not seem to be an alternative to the CAPM, at least in the world of practitioners, that seems to be gaining traction?
Well, I think first of all to recognise that you're right. Despite 70, 80 years of this and 5 Nobel Prizes for the effort, it's a dirty little secret in academia. We don't know how to calculate the cost of capital. Okay, so this is one of the rules of fundamental investing is understand what you know and understand what you don't know. And this, I think, is a matter of in the class of what we don't know. Mm-hmm. Now, the way we preach in the book is, well, first of all, to recognise that the cost of capital, the discount rate, the hurdle rate, is different for every investor. Okay. I remember back in the financial crisis, I was teaching my class. November of that year, after the whole thing had collapsed, the S&P 500 dropped eventually to 667, I think. Warren Buffett wrote a piece in the New York Times saying, now's the time to buy stocks. So I took the New York Times piece into class and said, he says, you've got to buy stocks. Now's the time to buy stocks. Are you buying stocks? No one in the class answered, yes. Pressing a little further, well, why aren't you buying stock? One student says, well, Professor, we're doing an MBA. It looks like the bottom may fall out of the whole finance business. This is a finance school. We may not get a job. We're very highly exposed to risk. We can't take on more risk. We, like all the other investors at the time, are fleeing risk. Another says, hey, I've got student debt up to the ceiling, okay? I'm highly levered. I'm just in a real risk position. They're saying, my cost of capital is very, very high. And then they turn on me, which they should, and said, Professor, are you buying? I said, yes, actually I am. But you've got to remember, I don't have much debt. I've almost paid off my mortgage. I've got a job. And Columbia University is silly enough to give me tenure. So I'm in a very different situation. Warren Buffett's in a very different situation. The story brings out we all have a different discount rate. So the book then says, for equity investing at least, investing in firms, I cannot tell you what your discount rate is. Now, I can tell you how to get an idea of risk by actually pro-forming the future. What are the risks to sales? What are the risks to margins? I can give you the valuation under different scenarios to give you a sense of how I can end up under different scenarios to quantify that risk. This I can do, but I cannot tell you that you should use an 8.5% cost of capital. It's up to you. You put in your own hurdle rate. Institutional things enter in. Well, if I'm managing other people's money, what do I use? And we've got to think about that. So in the end, the book comes to the conclusion to actually think about there's a cost of capital out there that I can find, just as there's no intrinsic value out there that I can find. That's a fool's errand. Don't think you can find it. Now, what do I do? Well, first of all, don't you let an asset pricing model think you're going to bail you out. You employ the capital asset pricing model, and it tells you, hey, it's not 8.6%, it's 8.9%, okay? And by the way, that little bit of the difference has a big effect on valuations, particularly combined with the growth rate. That's a fool's errand. And the capital asset pricing model, which you say is used so ubiquitously in practice in courts, I mean, it's a very strange model in my mind. Okay, a risk-free rate. Well, what's the risk-free rate? Oh, well, let's use the 10-year US bond rate. The US has never defaulted, okay? No, we're getting a bit worried about that, to tell you the truth. Well, hold it. If a few years ago, when interest rates were at almost zero, you use that, you'd need your mind read, understanding they're printing so much money here, there's going to be inflation down the line. You are not going to get that return. That's not a risk-free rate. Holding those bonds, the value is going to be eroded by inflation. And then, of course, there is the other components, which is the market risk premium, which is the expected return on the market relative to the risk-free rate. Well, expected return on the market, where do I get that from? I don't know. Now we can do surveys, and you know what people use? I don't know what you use like in the courts. They use 5% or 5.5%. Why? Because that's what they were told to do in business school. See, we professors, with the idea we want to pretend that we're giving something to students. We give them these fake models, okay? Oh, use 5.5%, okay? And then there's a beta, which is estimated with 0.2 of a standard error. It's a mess. So that's the way to think. Don't pretend you can get this. And actually to think that the complexity of modern corporation that you're investing in, the number of risks they're faced about, an international corporation, to pretend that you can get that risk and funnel it down into just one number. Hey, it's 8.6%, it's not 8.9%. It's sort of stupid, in my mind.
Yeah.
Understand what you know, what you don't know. We don't know this. Now, in your situation, you have a problem because you have to come up with intrinsic value and you have to use a discount rate. Ubiquitous of the capital asset pricing model, I would guess, Nico, is because that's what we taught them in business school. We have to do something. Here's something off the shelf. We can do it, okay? Judges, I'm just guessing here, judges look at what is common practice. So we choose this is common practice, and the judge says, I don't know either, but this is common practice, I'll accept it. Correct me if I'm wrong. But so that's the way I think about it. But a fundamental analysis, you know, one of the basic ideas in fundamental analysis, again going back to the traditional fundamentalists, Benjamin Graham, is be very suspicious about models. Even be suspicious about valuation models. Even be suspicious about the residual income model. Pretend you can put in a growth rate. That's what leads us to this reverse engineering approach of challenging this to market. There's a quote in the book from Charlie Munger, who's Warren Buffett's sidekick, recently deceased. He says, I got this quote from him, he says, listen, in business school they use valuation models, which tell you to forecast the future cash flow and discount back using some sort of discount rate. He says, those valuation models, they're not very good. And he has a line that says, well, this is what they teach in business schools. Well, they have to do something, okay? Because you've got to tell the students, I can tell you what to do in practice, and then this becomes institutionalized as they go out to practice. This is sort of my cynical view of the world, maybe, but I think it's how it works.
Yeah. Yes. I'd like to ask about some long-term developments. Given that there's such a slow pace of change, at least things that arrive at a practitioner's level, if you had to speculate, Stephen, where you think that real innovation in the thinking about risk and return will come from over the next decades, where would you expect it to be? Is it behavioral finance? Is it empirical research? Is it artificial intelligence? Is it a scenario-based approach as you lay out in the book? Is there even a road ahead in terms of conceptual thinking about risk and return that will give us something new in terms of valuation models? Is there going to be small steps of incremental improvements in your mind, or a big idea like the CAPM 60 years or 70 years ago? What's your view?
Yeah, that's a very good question. I think the basic thing in fundamental investing is understanding the business. Okay, information is gold. So getting information is very, very important. So the generation of information about the business is very, very important. There's a question of who gets the information, who gets it first, which is a legal issue, an equity issue. But that's very important. So to the technology in terms of eliciting information, which of course has increased tremendously over the years with scraping of information from the web, from satellites and so on. AI are probably going to be very helpful in that. Though I'm more an observer of AI, I see what's going to happen rather than being part of it. That's very important. The book emphasizes the accounting fundamentals, but actually the primary thing is investing is understanding the business. Warren Buffett says, look, when I buy a business, I really understand. But one thing's for sure, next morning I sit down to my breakfast, I pour myself a cup of coffee, and I read the 10K, I read the annual reports. Okay. So I think the acquisition of information and the sorting out of information that has integrity from the fake news, okay, is going to be important. Whether AI is going to help us with that or not, I'm not sure. That includes advancements in the accounting and disclosure. So I think these are important aspects. The basic way of approaching it, okay, in my mind, is sort of in place. If you use balance sheets and income statements, it's a question of the integrity of the accounting and the honesty of the accounting. Okay, so in China, I actually think the accounting has lacks integrity. That's a risk of investing in China. Now, in terms of behavioral factors, yes, I think behavioral factors are going to come more to the fore. Fundamental investors look at the fundamentals and make an assessment where the price is different from what they think it's worth. Okay. But the flip side of that is if you think the price is different from what it's worth, the question is, why is it different? And that presumably entertains the idea that there's behavioral factors that are generating the price. That can be herd instincts, psychological issues, whatever. Not my area, okay? But there's two legs to investment. There's legs of understanding the fundamentals that give you some sense of the value and its and the risk, and then understanding the fundamentals. So if in fact you're in 1998 and you think, man, the fundamentals don't justify this price, but I have behavioural reason why the price to book ratios are so high. Okay, that gives you added insurance. Behavioural finance is behavioural finance or behavioural economics is at a very early stage. Okay, a lot of it has to do with psychology, which actually I don't think is an important thing because some of us can be irrational. I can be irrational. But in aggregate, it's a question whether in aggregate the markets are irrational, with somehow people who are rational missing out on the arbitrage opportunities. So I think that's going to be an important aspect of the development.
Yeah.
So in summary, gaining information with integrity. Okay, we're filtering out the good information about better accounting. Okay, particularly for some industries, and understanding the behavioural influences in conjunction with the fundamental analysis. That's where I'd like to see it proceed. As I said, I use the AI to ask questions, but I'm not. My disposition at the moment is to think that actually it cannot be creative. It can give you knowledge by scraping knowledge. It cannot give you knowledge, but I'm very intricate that the human can give you in terms of thinking about businesses and thinking about economics more generally. But I'm just an observer. I'm very keen to see just how far that's going to go and how far it's going to help me and how far what I'm going to watch out for if I'm going to use those tools.
Yeah, great. Thank you. And lastly, if we forward 50 or 100 years, and let's say we reconvene and have the same discussion in 50 years or 100 years, or maybe our grandchildren have the same discussion, then what do you think will be the standard approach to valuing a firm 50 or 100 years out? Not just damages, but generally, what do practitioners then use to value a firm? What do business schools then teach their students on how to do? You think it'll be the CAPM? Do you think it'll be the residual income method or something entirely different?
My persuasion is almost imperatively it has to be a accrual accounting-based model. Okay. Now, the impediments to that are, first of all, there is a very wide lack of understanding how accounting works and what you can get out of accounting. Okay. The general public opinion of accounting is it's bookkeeping, it's numbers, it's rules. It doesn't have much to do with reality. My view is quite opposite, whereas we're very much aware of the limitations of what you get in accounting, and actually they're good limitations because accounting says, I won't speculate. Benjamin Graham again. You accountants, tell me what you know, but leave the speculation to me, okay? But getting back to the point, there's almost a dismal appreciation of how important accounting is. I think accounting is very important. If you want a capitalist economy, a free market society, free enterprise society, there's certain things have to be in place. One is property rights. One is good courts to enforce those property rights. And ranking probably third is good accounting. And we don't have that mentality. I must say, one of our problems with the techniques that have come down from business schools is our finance colleagues, my finance colleagues, and I count myself as finance colleagues as well as accounting. They're finance schools, or have been finance schools. they don't understand accounting. They haven't got the aesthetic of how accounting works. To say, look, it's balance sheets and income statement, they work together, and this actually deals with the intangible asset problem. It's psychological blackout, okay? So they work, basically, they're still on discounted cash flow analysis because they can't think of they think accounting is, it's sort of arbitrary. And they would say, well, I'll give you a model, okay? Take this model, the CAP-M, and run with it. So the broader education of the importance of accounting and of what you can get from accounting is what's going to determine things in 50 years, okay? Think of government accounting. It's terrible. It's cash accounting, okay? It doesn't even have a balance sheet. Somewhere or another, the national debt is in a bottom drawer somewhere or other, okay? And in the US, it's getting quite alarming. There's no balance sheet. Yeah, let's keep track of the national, but let's look at the assets we have also, okay? And let's look at pro forma future statements. It's appalling. So that's a key thing in my mind. And one thing you do is as you go through fundamental analysis and you start using the accounting, and the book's written from this point of view, is that you understanding the extent to which the accounting helps you and how it hinders you. Okay, and there's 2 chapters in the book on the accounting, on the balance sheet. You can watch out for this, watch out for that. Okay, it's going to hurt you. So the delightful thing about what I do is I'm in value investing, but I'm an accounting professor as well as in finance. I'm an accounting professor. So I can now come back and say, hold it, for this purpose, for investing. And there's a lot of trades every day in the world on the stock markets. There's a lot of buys and sells. For this purpose, I can tell you, I think with some empirical research to back it up, this is the better accounting. So part of my work is writing policy papers on intangible asset accounting, for example, okay, on stock option accounting, on other things, and talking to the IASB, the FASB board members, okay. And I think that's that I see that as my ultimate mission, okay, because and trying to get the message across. I hope as people read this book, the light goes on. Oh my goodness. As in my class, as I teach, the students say, oh, we had to do an accounting course. They required us to. They come out of my class and say, I want to go back and do some more accounting. Mm-hmm. There's a wonderful clip from Warren Buffett to MBA students, I think at Wharton. You go and you do study your accounting. This is very, very important. So there's my sermon for the day. Okay.
That's great. Thank you so much, and thanks for joining us today, Professor Penman.
Thank you very much for talking to me. I very much enjoyed it.
Thank you.